Hey everyone, welcome back to Corporate Decoder, the place where we rip open financial reports and see what is really going on inside these companies. Let's dive into the world of a China growth ETF and see if it is a golden ticket or a paper tiger. This report is all about the performance of the Core Values Alpha Graded China Growth ETF, otherwise known as CGRO, from October 2024 to September 2025. Think of it as a yearly checkup on how this fund investing in Chinese companies has been doing and what drove its performance. First up, the fund is telling us how much it costs to invest in them based on a hypothetical $10,000 investment over the past year. They reported costs of $87, which works out to 0.75% of the investment. This is a pretty standard expense ratio for an ETF, meaning it is the cost of managing the fund but not a super high one to scare investors away immediately. Now, the really exciting part, what did this fund actually invest in and how did it do this? ETF focuses on China, and it highlights its performance against the S&P 500 Total Return Index, a very common benchmark for US stocks. The fund itself ended up at $16,177, while the S&P 500 was at $15,711. That means for every $10,000 invested, the Core Values Alpha Greater China Growth ETF returned about $6,177 over the reporting period, which is pretty solid growth. The S&P 500 in comparison returned about $5,711. So in this period, the China ETF outperformed a major US index. Let's look at the annual performance directly. The fund delivered a 31.49% return at net asset value. That's a massive jump. They are comparing this to the S&P 500 Total Return Index, which saw a 17.60% return. So the fund significantly outperformed its benchmark. Over its lifetime since inception on the 16th of October 2023, the fund has returned 27.83%. That's a strong start for a relatively new fund. The report stresses that past performance is not a guarantee of future results, which is a standard but important disclaimer every fund needs to make. So what made this fund's performance so strong? The report says it was a combination of tailwinds from a recovery in Chinese equities, and importantly the fund manager's ability to pick winning stocks. They talk about capturing alpha, which is essentially beating the market because of smart investment choices, not just riding the wave of the overall market. They specifically mentioned an allocation to a company called PopMart as a key success story. The managers saw something special in PopMart, a collectible company that initially seemed niche but had strong brand appeal and international expansion potential. This bet paid off big time, with PopMart delivering over 400% return and becoming a top contributor to the fund's performance. They also strategically favored Alibaba Group and Tencent Holdings over JD.com in the Chinese internet sector, and this also proved to be a wise decision, validating their research-driven approach. The strategy here is to capture opportunities at the forefront of China's technological advancement. The team behind this fund has a strong venture capital background. This means they often look for companies very early in their growth stages. They emphasize their deep understanding of how these industries have evolved firsthand, from startups to global leaders, giving them a unique edge. Let's peek at some key numbers as of the 30th of September 2025. The fund size was about $11.8 million. They held 30 different investments. The total advisory fee was a significant $68,815, which might seem high for an $11.8 million fund, but after accounting for reimbursements and waivers, it essentially brings the net expense down to that 0.75% we saw earlier. The portfolio turnover rate was 93%. This means nearly all the holdings in the fund were bought and sold within the year. A high turnover rate can sometimes indicate active trading and potentially higher transaction costs, but it can also mean the managers are actively repositioning the portfolio to chase new opportunities. Looking at the sector breakdown as of the 30th of September 2025, it's no surprise that information technology and internet-related companies play a massive role. Communications takes up almost 50% of the net assets, then consumer cyclical at 22.2%, followed by industrials and consumer non-cyclical. Financials and technology make up smaller portions. This sector focus shows where the fund sees its growth potential in China's evolving economy. The top 10 holdings give us a clearer picture. Alibaba Group Holding Limited is the largest at 10.2%, then Tencent Holdings at 9.1%. Xiaomi Corp comes in at 7.5%. Other notable names include Trip.com Group, UB Tech Robotics, Luckin Coffee, Horizon Robotics, Meituan, BYD Company Limited, and PDD Holdings. These are all major Chinese companies, many of which are tech or e-commerce giants. This concentration in a few giants means the fund's performance is heavily tied to these specific companies. Digging into the schedule of investments is where we see the specifics. We find companies like BYD Company Limited for auto manufacturers and Eastrock Beverage Group for beverages. For computers, Horizon Robotics is a holding. In the consumer discretionary space, we see PopMart International Group, which the report specifically called out. The internet sector is where many of the big names are, including Alibaba, Bilibili, East Money Information, Full Truck Alliance, JD.com, Kuaishou Technology, Meituan PDD Holdings, Tencent Holdings, and Trip.com Group. This confirms that the internet and technology are indeed the core of this fund's investments. Also notable are holdings in machining diversified like Ubub Tech Robotics and retail like Luckin Coffee. Let's look at the statement of operations for the year ended the 30th of September 2025. Investment income from dividends was $110,379. After some fees and taxes, the net investment income was $101,672. Expenses were primarily the investment advisory fee, which was $81,660, but after some reimbursement from the advisor, the net expenses were $68,815. This resulted in a net investment income of $32,857. But the big story here is the realized and unrealized gains and losses. The net realized gain from investments was a whopping $579,792, combined with a significant change in unrealized appreciation of $1,794,983. The fund saw a total realized and unrealized gain of $2,593,158. This led to a net increase in net assets resulting from operations of $2,626,015. This clearly shows that the growth in the fund's value came predominantly from the appreciation of its investments, rather than from the income generated by them. Looking at the statements of changes in net assets, we can see how the fund's value grew. For the year ended the 30th of September 2025, the net increase from operations was $2,626,015. There were distributions to shareholders totaling $183,743. Capital transactions saw a net increase of $166,155, which includes shares sold and redeemed. All in all, the net assets of the fund increased by $26,08427, bringing the total net assets to $11,815,976. This growth reflects successful investment performance and shareholder activity. The financial highlights per share give us a good snapshot. For the year ended the 30th of September 2025, the net asset value per share grew from $24.55 to $31.51. That's a substantial increase. The total return for the year was 31.49%, which aligns with the annual performance figures we saw earlier. The ratio of expenses to average net assets after reimbursement was 0.75%, which is a bit higher than the cost of a $10,000 investment, because it's a percentage of the total assets. Something interesting is the portfolio turnover rate, which was 93% for this year compared to 112% in the previous period. It is still high, but shows a slight decrease in how often the managers were buying and selling. Now, for some of the nitty-gritty in the notes to the financial statements. The fund is a series of Tidal Trust II and is managed by Tidal Investments LLC with MSA Power Funds LLC as the sub-advisor. They elections to be taxed as a regulated investment company, or RIC, something that ensures they avoid special taxes by distributing most of their earnings to shareholders. They also outline their security valuation policies, saying that most of their investments are categorized as level 1 under the fair value hierarchy. This means they are valued using unadjusted quoted prices in active markets for identical assets, which is good because it implies relatively liquid and transparent pricing for most of their holdings. This section is crucial for understanding what could go wrong. The fund acknowledges significant risks related to China investing risk. This includes the economy's sensitivity to political and economic conditions, potential government control, and regulatory challenges. They also mention the PCAOB's limited ability to inspect auditors in China, which could mean less transparency in financial records. There are also sector risks specifically called out for communications, services, consumer discretionary consumer staples, financials, healthcare, industrials, and information technology sectors. Finally, there is growth investing risks, which acknowledges that if their bets on fast-growing companies don't pan out, the fund could suffer. The report is essentially saying that the Chinese market is exciting, but comes with a unique set of challenges. Here they detail the fees. The investment advisory fee is 0.89%, but through a waiver it is reduced to 0.75% until at least January 2026. This waiver is important because it makes the fund more attractive to investors by lowering the perceived cost. The sub-advisor MSA receives a fee of 0.04% paid by the advisor. The report also mentions Tidal ETF Services, which is an affiliate of the advisor, and provides administrative services for an additional fee. This is common in the fund industry where related parties provide services and are compensated. This is the auditor's stamp of approval. Cohen and Company Limited states the financial statements present fairly the financial position of the fund, all in accordance with generally accepted accounting principles in the United States. They also mention they have audited one or more Tidal Investments, LLC investment companies since 2020, which suggests a long-standing relationship. Finally, there is some tax information. For the year ended the 30th of September 2025, about 47.69% of the dividends paid were considered qualified dividend income, which often receives favorable tax treatment for individual investors. A very small portion, around 0.08%, qualifies for the corporate dividends received deduction. So what is the verdict on this core values Alpha Greater China Growth ETF for the period ending in September 2025? The fund delivered strong performance, outperforming major benchmarks and demonstrating the power of their stock selection strategy, particularly with the PopMart investment. The high portfolio turnover suggests active management, which in this case paid off handsomely. However, the inherent risks of investing in China and in growth companies are substantial and clearly laid out. The reliance on a few top holdings means that the fate of these companies heavily influences the fund's overall success. While the expense ratio after waivers is competitive, the fees for various related services are something to keep an eye on. Overall, the fund shows promise, but investors should carefully consider the risks associated with concentrated bets on emerging markets and growth sectors. What do you think about this ETF's performance and its strategy for navigating the Chinese market? Let us know your thoughts in the comments below. If you found this breakdown helpful, hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description for more exclusive content and discussions. Thanks for watching, and we'll see you in the next one.